Welcome to the Deep Dive. We're the show that cuts through the noise, really zeroes in on the insights you need to be, well, truly well-informed. And today, we are tackling something fascinating, a real contradiction, I think. It probably made you pause this Monday morning, that's June 23rd, 2025, if you happen to glance at the financial headline. So you see news hit the wire about a U.S. strike on Iranian nuclear sites. Geopolitical tensions are, by any measure, really simmering. And what did the global markets do? They show this remarkable resilience. In fact, they're not just holding steady. Major U.S. indices actually climbing higher. It feels, well, profoundly counterintuitive, doesn't it?
Yeah, it absolutely does. Yeah, on the surface, it's exactly the kind of day that can leave even, seasoned market watchers just scratching their heads, trying to square those stark headlines with the calm, maybe even green numbers flashing up on their screens. So for us, the mission in this deep dive is really to pull back the curtain on exactly this phenomenon. We're going to explore that intricate, often unseen web of market drivers, everything from the tiny movements in oil prices to the subtle but, powerful cues coming from central banks, the latest corporate news that's shaping how investors feel, and even the global economic data that's creating a very, very specific kind of environment. These are the underlying forces that are, well, undeniably fueling today's unexpected rally.
And crucially, we're also going to shine a spotlight on those lurking risks. Those potential lightning bolts that maybe they seem distant today, but they could shift sentiment in a heartbeat. Now, this isn't about giving you investment advice, just to be clear. It's about providing you with those aha moments, right? That deeper context that lets you truly understand why the market is behaving the way it is. And to do this, we've pulled together a formidable stack of fresh same-day reports. From sources you trust, Reuters, Bloomberg, MarketWatch, Barron's. Think of us as your expert guides, sort of navigating these critical insights to bring you the most important nuggets of knowledge from all that material.
Yeah, consider this your essential shortcut, maybe, to understanding the market's current mindset. Moving beyond those, sensational headlines to what's really driving things.
Okay, so let's unpack this central puzzle. It's Monday, June 23rd, 2025. And as we just mentioned, the backdrop is undeniably significant. News of a U.S. strike on Iranian nuclear sites. Now, if you were just going by that headline alone, your gut reaction, well, it might be to expect a sharp market downturn, right? You'd picture panic, maybe widespread sell-offs, a flight to traditional safe havens. Historically, that's often been the playbook when geopolitical tensions flare up like this, especially in such a volatile region.
You're absolutely right. That initial sort of knee-jerk reaction to a headline that big, it often sends shivers through various asset classes. Energy markets especially tend to react pretty dramatically to any perceived threat to supply. Yet today, that's simply not what we're seeing across the broader market. Not at all. Instead, major U.S. stock indices, they're actually showing gains. And look, this isn't just a minor blip on the radar, it's a profound signal. It tells us the market is interpreting multiple, often conflicting inputs in a very specific and maybe surprisingly optimistic way. It suggests there's a more complex, almost philosophical calculation going on within the collective investor mind.
So let's get precise. To give you the picture, as of our check-in this morning, around 10:33 a.m. Eastern Time, we're seeing some truly interesting numbers across the board for these major U.S. index tracking ETFs. Take the SPDR S&P 500 ETF Trust, SPY, currently at $597.84. Now, that's a modest gain, $3.56 from its previous close, about 0.6%. It had even touched an intraday high earlier, $598.21. Now, okay, 0.6% might not sound like a roaring rally, but you have to consider the context.
Exactly. Context is everything here. And similarly, you look at the Invesco QQQ Trust Series 1 that tracks the NASDAQ 100, standing at $529.66. That's up $2.83 from its close, a gain of about 0.5%. It touched an intraday high of $530.15. What's fascinating here isn't the sheer size of these percentage gains. We're not talking about some huge multi-point surge. It's more about the direction and the stability in the face of such a, significant geopolitical shock. Typically, a headline like a U.S. strike, that would trigger a far more dramatic, immediate flight to safety, maybe even a negative open. The fact that SPY opened around $595.02 and QQQ around $526.74, and they've both trended upward since. Well, that indicates a profound defiance, really.
Yeah, defiance is a good word. And let's not forget the Dow tracker, the SPDR Dow Jones Industrial Average ETF DIA, priced at $423.84, showing a gain of $2.08 from its close, moving up about 0.5%, and it hit an intraday high of $424.07. So it's really crucial to grasp here for you, our listeners, that all these major U.S. index tracking ETFs are, quote, modestly green. And this isn't just happening in isolation today. This positive movement, it actually builds on and extends the rebound we'd already started seeing last week. This subtle green, that's the real aha moment we're dissecting today, I think.
It truly is. The fact that all these broad market indicators are moving in the same positive direction, even if it's gently, it speaks volumes. It suggests there are these deep-seated underlying forces at play, forces powerful enough to override what would typically be a highly negative catalyst. So the core question for us, and really for you, the listener, is precisely this. How can the market possibly be rallying, or at least showing such remarkable resilience, on what you'd call a war headline Monday? Understanding this gap, right, between the dramatic, attention-grabbing headlines and the calm, even positive market reaction, that is absolutely key to becoming truly well-informed. It's about looking beyond the obvious to what's truly driving sentiment and, well, where the capital is flowing.
Okay, so let's dive into that then. Our sources today, they repeatedly bring up this overarching narrative, and it perfectly captures what we're seeing. The market is climbing a wall of worry. It's a classic market adage, isn't it? It means that despite this constant barrage of potentially negative news, could be geopolitical conflicts, economic uncertainties, inflation fears, policy shifts, you name it, the market not only holds its ground, but actually manages to grind higher. It's almost as if every headline that could have triggered a major sell-off has instead, well, as our sources so eloquently put it, just landed with a thud.
Exactly. This wall of worry dynamic, it signifies a fundamental shift in market perception, maybe even a learned shift. It's not that investors are ignoring the bad news. I don't think that's it. Rather, they're either discounting its long-term economic impact, maybe finding mitigating factors, or perhaps just prioritizing other more bullish drivers that they believe will ultimately win out. Think back to, say, the initial days of the Ukraine conflict, or even those heightened trade tensions just a few years ago. Markets could have crumbled under the weight of all that uncertainty, right? But they often find a floor and then begin that grind higher, even while those concerns are still ongoing, still unresolved. This resilience, this ability to absorb negative news without collapsing, that's the fundamental shift we're analyzing today. And it's powered by several key factors.
That makes perfect sense. Okay, so with that big picture narrative in mind, let's start peeling back the layers. Let's look at the first major driver. And this one's particularly relevant given today's geopolitical news, what we're calling oil shock fatigue, combined with geopolitics being largely priced in. So we saw crude oil prices briefly top $78 a barrel right after Saturday's U.S. strikes on those Iranian nuclear sites. Logically, you'd think that'd be a huge red flag, wouldn't you? Signaling higher inflation, higher production costs, broader economic disruption.
That's certainly the expected reaction, the almost reflexive knee-jerk response, yeah. However, here's where it gets really interesting, and Reuters highlighted this. Crude quickly slid back, fell right back under $74 a barrel. Now, this rapid reversal is profoundly telling. It suggests that traders are essentially betting. They're betting Iran won't actually follow through on threats to close the Strait of Hormuz, that critical choke point where a huge chunk of the world's seaborne oil supply passes through. And furthermore, there's this widely held belief, seems to be reinforced by market intelligence, that there is ample OPEC plus spare capacity available. That acts as a pretty substantial buffer against potential short-term supply disruptions. It significantly reduces the perceived risk of a sustained destabilizing oil shock.
Okay, so why does that matter so much to the broader market? I mean, beyond just the price at the pump for us.
Well, it's huge.
Lower than feared energy prices are absolutely crucial because they directly reduce that threat of stagflation. That really ugly, economically painful mix of stagnant growth and persistent inflation. For consumers, sure, stable or lower fuel costs mean more disposable income. That's clear. But beyond that macro point, they directly support corporate profit margins, especially for sectors like transport, logistics, consumer-focused stocks. They're highly sensitive to fuel costs. When fuel costs are stable or declining, those companies see a direct positive impact on their bottom line, and that's inherently bullish for their stock prices.
And if you connect this to the bigger picture, you can actually see supporting evidence of this sentiment in other places, maybe unexpected places. Tel-Aviv's MSCI index, for instance, is hitting record highs. Now, that's a very telling signal coming from a region directly impacted by Middle East tensions. It implies that investors who are closest to the potential flashpoints, they're not panicking. They are, in effect, seeing the situation as contained, or at least manageable. And the broader sentiment among U.S. investors, well, according to strategists like Ed Yardeni and folks at Morgan Stanley, is one of geopolitical fatigue. They argue that a wider, sustained, economically debilitating conflict It's just deemed unlikely to unfold from this specific event. And this keeps the global risk premium, that extra return investors demand for taking on perceived risks, relatively low. It allows other market drivers to really take center stage.
That's a really compelling argument for why the oil reaction was so muted. Okay, but oil isn't the only piece of this puzzle giving investors surprising confidence, is it? Our second major driver takes us straight to the Federal Reserve. The market's pretty firm belief that the Fed is still very much in play for rate cuts. Bloomberg's report was quite explicit on this. The Fed held rates steady last week. Okay, no surprise there. Anyone following monetary policy expected that. But what was absolutely crucial and what the market immediately latched onto is that they kept 2 rate cuts penciled in for 2025 in their latest projections. So this raises an important question. Why does the market still believe cuts are genuinely on the table, even with all these global uncertainties and lingering inflation concerns still around?
Fundamentally, it boils down to the data and how the Fed is interpreting that data. The softer May Consumer Price Index, the CPI, that's our main inflation gauge, right? Measuring price changes for consumers. It only rose by a modest more 0.1%. That gave the Fed precisely the wiggle room it needs. It indicates that maybe those inflationary pressures are easing faster than previously thought. That gives the central bank more flexibility to consider rate adjustments. And to further back up this dovish feeling, we had a fresh hint from Fed Vice Chair Bowman just this morning, actually. She reinforced the idea that the Fed is indeed considering an easing path, but, contingent on continued data cooperation. That's a very strong, consistent signal to the market.
And the market impact of those easing prospects, it's absolutely critical, isn't it? Because lower interest rates, they have this profound ripple effect. They offset concerns about, say, higher tariffs or potential inflation spikes that might pop up elsewhere. More importantly, they directly help support what some might view as, lofty PE multiples, those price-to-earnings ratios on many stocks. When borrowing costs are lower, companies can finance growth more cheaply. And critically, the present value of their future earnings, which is what investors are really buying, right, gets discounted less heavily. So this makes current valuations, even those seemingly lofty PE multiples getting near 21x, appear more justifiable to investors because those future profits are worth more today. It's a fundamental mathematical tailwind.
Precisely. Lower rates essentially boost the present value of future corporate earnings. Simple as that, really. And this acts as a powerful tailwind for equities. It provides a fundamental justification for continued equity strength, even at these higher valuation levels. It also makes bonds less attractive relative to stocks, which encourages a continued flow of capital into the equity market.
Okay, driver number 3 contributing to this resilience. It's the unwavering enthusiasm around AI, artificial intelligence, and just broader corporate buzz. This tech leadership narrative, it just continues unabated. It's clearly a major force underpinning the market's current strength. We saw specific examples today, like AMD stock jumping on a fresh buy upgrade, directly tied to its Instinct MI350 AI chips. Now, this isn't just about one company. It profoundly illustrates the ongoing strength and, frankly, investor confidence in the entire AI sector. It suggests investors believe AI isn't some fleeting trend, but a truly transformative technology, one that will drive significant tangible revenue and profit growth for years to come.
And it goes beyond just AI, too. We're seeing a pretty significant resurgence of M&A headlines, mergers, and acquisitions, which are stoking, as our sources put it, animal spirits in the market. A prime example today. C&S Wholesale Grocers acquiring SpartanNash. That's a $1.77 billion deal. This kind of significant M&A activity is widely interpreted as a strong sign of corporate confidence. It suggests companies are optimistic about future growth, they're willing to deploy capital, and they believe the economic environment supports these kinds of strategic moves. Moves which are often done to gain market share, achieve synergies, or maybe expand into new areas.
So what does this mean for the market? It's fascinating, actually. Well, some economists, some analysts, might interpret aggressive deal flow like this as indicative of a late cycle economy. The point where companies consolidate because organic growth is slowing down. The market generally views it as a fundamentally bullish signal. It reflects deep confidence in the underlying economic landscape, in future earnings potential. It shows that corporate balance sheets are healthy, cash is being put to work productively, and there's a strong belief these acquisitions will lead to synergistic value, increased profitability, which, at the end of the day, benefits shareholders.
Indeed. It's definitely a signal that management teams are seeing opportunities for strategic growth, and they're putting their money where their mouth is, so to speak. This reinforces that broader narrative of corporate health and the potential for continued earnings expansion. Even facing macro uncertainties, they're focusing on those micro-level opportunities.
Okay, that brings us neatly to our fourth driver, Strategist upgrades fueling what's widely known as FOMO, fear of missing out. This is a powerful psychological factor in market dynamics, almost primal sometimes. And it's clearly at play right now. We saw specific calls, like Morgan Stanley reiterating its stay long call on stocks. What's truly fascinating here is their specific argument. They believe crude oil would need to spike. Get this, a whopping 75% year over year to significantly dent corporate earnings per share, EPS. I mean, that's an incredibly high bar for oil to actually become a market disrupting factor.
That's a very precise metric, isn't it? And quite reassuring, coming from such a prominent institution. It essentially tells the market that the current level of oil prices, even with all the recent geopolitical noise, is far from being an earnings threat. And you're absolutely right about the impact of these strategist upgrades. For fresh upside targets from prominent strategists, they have a tangible, immediate impact. They can trigger significant FOMO flows, meaning money starts pouring into the market, not just from systematic funds programmed to follow momentum, but also from individual retail buyers who, fear being left behind as the market climbs higher. This creates a powerful positive feedback loop, just pushing prices up further.
So it's not just the underlying fundamentals we've been talking about. It's also the psychology of investment that's a massive force here. When a respected strategist, especially from a major bank, publicly states the market has significant upside potential despite the headlines, well, it can persuade those fence sitters to finally jump in, or it encourages those already invested to maybe allocate even more capital. This cascade effect, this rush to participate, it's a potent force. Especially in a market that's already showing such remarkable resilience, it adds momentum to an already upward trajectory.
It becomes a kind of self-reinforcing prophecy, doesn't it? The strategist upgrades breed confidence, that confidence translates into increased buying activity, and that buying further validates the bullish outlook. It's a powerful mechanism for momentum, quite distinct from, though often reinforced by, the other fundamental drivers we're discussing. It can definitely propel a market higher, even when some might argue the fundamentals look a bit stretched.
Okay, fifth driver contributing to this Green Monday. It's what we're calling a Goldilocks global data mix. Not too hot, not too cold, but just right for the market's preferred scenario. We've seen Euro Area Purchasing Managers Index, PMIs, tick up. That indicates improving economic health across Europe. And the PMI is a key indicator, right? It gives insight into manufacturing and services and uptick signals expansion. But simultaneously, U.S. economic data has shown some signs of softening, suggesting a cooling, but importantly, not collapsing domestic economy.
Right. And this combination, as Reuters noted, it truly creates a Goldilocks scenario, especially from the perspective of central banks. Better growth in Europe. That means less pressure on the European Central Bank, the ECB, to be overly aggressive with rate cuts, gives them flexibility, stability. Conversely, softer U.S. data provides more justification for a dovish-leaning Federal Reserve. It supports those rate cut expectations we just discussed without raising fears of a recession. It's this delicate balance that markets currently seem to love.
And there's a direct currency and earnings impact from this divergence too, which is crucial for multinational companies. This mixed bag of global data, Europe strengthening, U.S. cooling it, tends to lead to a weaker U.S. dollar. Now, when the dollar weakens against other major currencies, it means U.S. companies doing significant business overseas. Well, their foreign earnings translate into more U.S. dollars when they bring them back home. Think of it like this. If you're a U.S. company selling widgets in Europe, and the euro strengthens against the dollar, every euro you earn suddenly converts into more U.S. dollars when you repatriate those profits. It's like getting a bonus just for your overseas operations. Directly boosts reported profits and, by extension, stock valuations.
Yeah, it's subtle, but it's a profoundly powerful driver for those big U.S. multinational corporations. A weaker dollar really acts as a tailwind for these giants of industry. It effectively makes their overseas operations more profitable, at least on paper, even if their sales volume stays the same. This boosts overall corporate earnings forecasts, adding another significant layer of support to the current market rally.
Okay, so we've outlined 6 pretty powerful, interconnected reasons why the market seems to be shrugging off major geopolitical news and continuing its climb. But now, it's absolutely vital we talk about the other side of the coin. While the market is certainly in what we'd call risk-on mode, it would be a critical mistake for any informed observer to just ignore the tail risks. As the reporter's take implies, these are the potential lightning bolts, those low probability but high impact events that could flip sentiment fast. And for you, the listener, understanding these potential blind spots is absolutely crucial.
Absolutely. The current optimism, the market resilience, It's all built on a foundation of specific interpretations of events and a certain expectation of future trends. If those interpretations prove wrong, or if new, unforeseen, high-impact events pop up, sentiment could reverse with surprising speed. These are the what-ifs that, okay, maybe they're not immediate threats today, but they definitely warrant very close and continuous attention.
Right. So our first significant risk is this looming July 9th tariff cliff. It's a hard deadline, it's quickly approaching, represents a concrete date for potential disruption. Can you explain what exactly is at stake here and why it's causing some concern?
Sure. So on July 9th, that 90-day pause on new U.S. import duties, it's officially set to expire. Now, if this pause is allowed to just lapse without any further extension or negotiation, we could see tariff rates potentially double overnight on certain categories of imported goods. The threat level here is maybe categorized as medium, it's a known quantity, has a definite date, but its implications are significant. This could add an estimated 0.5 to 1 percentage point to the Consumer Price Index, CPI, essentially making many imported goods more expensive for consumers, for businesses. And this immediately raises a really important question. If inflation unexpectedly rises because of these tariffs, could it force the Fed to delay? Or maybe even reconsider those penciled-in rate cuts for 2025? Such a development would directly contradict one of the core, most bullish drivers of today's rally. It hits right at that Fed narrative.
Yeah, that's a direct, tangible threat to the dovish Fed story the market is leaning on so heavily. Okay, risk number 2, the Iran escalation wildcard.
Yeah.
No. While the market seems to have largely discounted the immediate impact of the U.S. strike, Iran has, well, unequivocally vowed a proportional response. What's the worst-case high-impact scenario here, even if it's considered low probability right now?
The high-impact scenario, yeah, still considered low probability by most traders and analysts, but it would be a full or even partial shutdown of the Strait of Hormuz. Should Iran take such a drastic, globally destabilizing measure, it would severely disrupt global oil supply. It could potentially push oil prices towards $110 a barrel, maybe even significantly higher, depending on how long the disruption lasts. The market vulnerability in that scenario, it's profound. It would disproportionately hit transport and consumer sectors first, right? Because of spiking fuel costs, leading to widespread inflationary pressures, potential demand destruction. Now, sure, energy and defense names might act as a hedge. Maybe they gain from increased demand or tension. But it would undoubtedly be a major market shock. It would completely undermine that oil shock fatigue narrative we talked about and likely trigger a broad market sell-off, big time.
And that leads directly into our third risk, valuation stretch. Even without these external shock, the market itself might just be getting a little ahead of its skis, suggesting maybe a degree of exuberance. What are the specific numbers telling us on this front? And how concerning is it, really?
Well, Reuters notes that equities are currently trading approximately 15% above what they call their macro fair value. This macro fair value, it's basically a theoretical benchmark. It's derived from long-term economic fundamentals, things like GDP growth, inflation, interest rates. Suggests where stocks should be priced given the broader economic conditions. To put it into more practical terms, the forward price to earnings, or PE, ratio measuring current share price relative to projected future earnings is currently near 21x. Compare that to a 10-year median of about 18x. Now, while this valuation stretch is categorized as, let's say, elevated but not extreme, it's not necessarily signaling an immediate bubble burst. It's certainly a yellow flag. It suggests there's less room for error, less buffer for the market to absorb unexpected negative news without a correction. It implies the market is already pricing in a lot of good news, leaving very little margin for disappointment.
Right. So even a small hiccup, just a minor piece of unexpected negative news, could potentially have a larger than expected impact simply because valuations already stretch. Okay. Our final risk, and this one's always sort of bubbling under the surface in political talk, is Fed independence noise. Okay. We're hearing rhetoric again from former President Trump hinting at firing Federal Reserve Chair Powell if he were to be reelected. How serious should we take this?
This specific risk, for now, is largely categorized as mostly political theater. Mostly. However, it's definitely worth monitoring very closely. Because if that rhetoric escalates significantly, or if there's any perceived genuine threat to the Federal Reserve's operational independence, it could roil the bond market. The bond market being incredibly sensitive to stability, predictability, it values the central bank's autonomy above almost everything else. Any uncertainty about its leadership, its ability to make decisions free from political influence, or its long-term policy direction, that could lead to significant volatility in bond yields. And that, in turn, impacts everything from corporate borrowing costs to mortgage rates, even the valuations of long-duration assets. So for you, the listener, the key is really to watch for any actual confirmation hearings or maybe significant sustained reactions in the US dollar. Those would be the real signals of this political noise translating into tangible market impact.
Okay, so we've taken a pretty deep dive into the surprising strength of today's market, the very specific drivers pushing it higher, and also looked at the very real, significant risks lurking just beneath the surface. Let's try and connect these dots now, synthesize what this all means for you, our listener. Today's rally, fundamentally, it seems to be a profound vote of confidence across several key areas. It's a testament to the belief in global excess oil capacity, right? Dampening those energy price fears despite the geopolitical tension. It's a vote for the perceived backstop of central banks, particularly the Fed's willingness to cut rates when data allows. That acts as a crucial safety net. And it's a powerful affirmation of continued profitability driven by tech innovation, especially AI, and that robust corporate activity like M&A.
Exactly. That wall of worry adage. It has truly played out today in almost textbook fashion. The market's remarkable resilience means that those potential negative catalysts, like the geopolitical headlines that would typically send shivers down investors' spines, are currently, as our sources put it, landing with a thud. They're failing to trigger major sell-offs, largely because these other, more bullish drivers are seen as fundamentally outweighing them right now. And this is a crucial insight for you to grasp when you're interpreting daily financial news. It's not enough just to see a dramatic headline. You really need to understand how the market is interpreting it, weighing it, discounting that headline against everything else, against that whole mosaic of other influential factors we've discussed.
And that's precisely the relevance for you, the learner. That's why we do this. This deep dive isn't about giving you investment advice. We always say that. It's about equipping you with a nuanced, truly well-informed perspective. Understanding these complex, interconnected layers helps you move beyond just the superficial headlines to truly comprehend the multifaceted forces at play in the market. It empowers you to dissect financial news, to discern what's truly important from what might just be noise, and to recognize why the market might be reacting in ways that maybe at first glance seem counterintuitive or even contradictory. Ultimately, it's about developing that critical thinking muscle when it comes to financial information.
Yeah, ultimately, it allows you to see the forest and the trees at the same time, avoiding that trap of just reacting solely to single pieces of information without the broader context. It's about building a sort of robust framework for understanding market behavior.
Okay, so as we wrap up this deep dive, let's just briefly recap those core drivers of today's market rally. That surprisingly muted reaction of oil prices to geopolitical tension, signaling oil shock fatigue. The lingering data-dependent hope for dovish Fed policy, keeping those rate cuts on the table. The enduring strength of corporate news, particularly in tech and AI, driving M&A and investor enthusiasm. The influential power of strategist upgrades fueling that FOMO. And finally, that Goldilocks global data mix creating favorable conditions. But remember, we also discussed critical risks that demand your attention. That looming tariff deadline on July 9th, which could reignite inflation concerns. The low probability but high impact potential of Iran escalating tensions further, especially involving the Strait of Hormuz. The already elevated market valuations that leave less room for error. And that persistent Fed independence noise that could potentially roil bond markets.
Yeah, and the reporter's take from one of our sources offers a pretty poignant final thought for today, something that really encapsulates the current market sentiment. The tape says, risk on until one of those low-probability, high-impact bombs actually explodes, which raises an important question for you, our listener, to consider as you process all this information. Are you truly prepared for what happens when the current market sentiment finally shifts? When that risk on maybe flips to risk off? Having gained this deeper understanding of both the powerful drivers and those significant tail risks, what specific tail risks are you now watching most closely in your own reading and analysis?
Think about how quickly market sentiment can flip, and the importance of monitoring these nuanced signals yourself, rather than just reacting to the loudest headlines of the day. Maybe reflect on how you currently process market news, how you can more effectively identify those underlying drivers we talked about. And perhaps even identify your own personal wall of worry elements that might be influencing your perception. Because the more informed you are, the better equipped you are to navigate the inherent complexities and, well, the surprising turns of the global market.